the coronavirus pandemic continues to hit hard on the petroleum industry globally. Now, after the benchmark price of U.S. oil futures dropped to minus $38 a barrel, international oil companies are now threatening a shutdown of production activities should the development continue further. Let's join founder of the Ghana Oil Drilling Academy and consultancy, Godak, Prince Frimpong, via Zoom for his perspectives and how badly the situation is. Of course, somewhere along the line, we also bring on board Raymond Nuopo, who is with the Institute of Energy Security. Now, Prince, you're welcome to the marketplace. Hello, Prince.
Yeah, hello, please. Can you hear me?
Yes, I can hear you loud and clear. Now, so what is your take on these threats that is coming from international oil?
The question of whether the industry is coming back to normal, well, can be pondered. Normal is no longer desirable nor secure. Now, we had an industry that was sitting on a global warming time bomb, the consequences of which will be mild if compared to global coronavirus results. At the same time, this industry was very hostile to the ecosystem. So perhaps what has happened to me will be a catalyst for the transition from fossil fuel to clean energy. Now, these major companies are dependent on government stimulus to revamp back to what you call normal. The question is, are people willing to use their tax monies to bring back this normal, or would we look at an economy that is better sustainable in the long term? So that's why we are here.
Yes, all right. So Prince,
the issue is a very questionable at this time, unpredictable, and perhaps never.
So Prince, the issue now is that ExxonMobil and then Chevron and other big companies, oil companies, are threatening to shut down. And of course, this will also trickle down to relatively smaller companies operating in Africa and elsewhere. Now, will this actually affect Ghana, for instance? Will Tullow shut down, and what will be the impact on the country?
Well, most likely because you cannot produce at a higher cost than what the market is ready to offer. Remember, the average market price for the crude now is around $25, which is not sustainable. So the cut in investment will trigger down the cut in activities, and automatically, when activities are cut down, eventually people would have to lose their jobs, and then the shutdown is just by the time. It's mandatory.
Now,
with the current price.
Before I bring in Raymond, I would like to know from you, Ghana, the GNPC, that's the Ghana National Petroleum Company, has in mind to become a standalone operator of our fields. Now that we have this situation, do you think that we should suspend as a country all exploratory activities and wait for normal times to return before we pursue them?
Well, you don't suspend exploration activities. They get suspended by themselves. Remember, the exploration is one of the cost-intensive part of the entire value chain. So that if the resources are not available, activities will die by themselves. But again, if you have the resources available, I would recommend that data gathering continues, that the exploration activities continues, because the better data you have about the blocks, the more attractive you make them for potential investors.
All right, so let's now situate let's bring the situation here home, and Raymond Nuopo is principal researcher at the Institute of Energy Security. Now, Raymond, why is it that the country has found it so difficult to reduce drastically petroleum prices in the downstream sector, even though on the upstream there are things, the situation looks favorable?
Come again, please. The line was faint.
Yeah, Ray. Ray.
Thank you very much for the opportunity, and good afternoon. Basically the coronavirus is... Hello, can you hear me?
Yeah, go ahead.
Yeah, I'm saying that basically the coronavirus has cascaded through the whole industry. So oil marketing companies are also facing some of the effects of the coronavirus. If you look at their average sales volume before the lockdown, it was around 5,000, and during the lockdown, their sales volume reduced drastically by 70%. They are now having an average sales volume of over around 1,500, which is huge for them. So it's making it difficult for them to reduce prices drastically. If you look at the window, look at the first quarter of this year, they have reduced prices between 15 to 20%. But because of the inability to sell in large volumes and they have to pay taxes to government, they are unable to continue to reduce prices as we see on the international market.
All right, so Ray, we don't have much time, but quickly, what will be the outlook for the first pricing window in May?
Okay, thank you very much. The first pricing window in May, prices are supposed to decline marginally. We say marginally because the OMCs are unable to sell the stock they have already. So therefore, they find it difficult to reduce prices drastically.
All right. Thank you very much, Raymond Nwokpo. He's a principal researcher of the Institute of Energy Security. Earlier, I was also joined via Zoom by Prince Frimpong. He is the CEO of the Ghana Oil Drilling Academy and Consultancy, Kodak. He's currently based in Norway. Thank you very much, gentlemen, for your time.